to start, I'm the co-founder and the CEO of Capchase. Capchase, we started a couple of years ago, and we are a fintech for SaaS companies. So we help more than 3,000 SaaS companies across the US and Europe to grow faster with non-dilutive capital, with insights, tools, and community, right? So what we're going to go through today is this amazing report that we did, benchmarking, a bunch of companies that I've connected to understand, what are the variables that differentiate the best companies from the rest, right? So, and just to give you an idea of how we have done this analysis, basically, in order to access our services, SaaS companies need to connect 3 sources of data. So banking, revenue, and accounting data, right? So then we have access to these tools in real time. So we can see how the data from these companies changes over time. So what we're going to go through today is 1, what differentiates the best companies from the rest? And then 2, how have those variables, that indicate whether that company is amazing or good, how those variables have changed during the downturn. So let's start with one of the most important things for a SaaS company, which is growth and growth speed, right? Growth is probably one of the most important drivers of valuation. And we're seeing that the top companies, the top quartile, grows extremely rapidly, right? So 160% growth year over year on average. And why is growth so important? Because growth compounds, not only because the same growth, 100% growth year over year, gives us that beautiful hockey stick that we all love, but because you actually, the faster you grow, the better team members you can attract. Those team members usually figure out things faster than everybody else and better than everybody else, and then the company grows faster, and that gets the flywheel going, right? So what we see is that the best companies are growing so much faster than the median that they're actually, pulling away and leaving a big gap. And how do they do this, right? So again, we have 3,000 companies, 3,000 customers. We talk to them all the time because we help them with growth. So basically what we extracted is that the best companies grow faster because they really, really, really focus. And this is a little bit hard for us as founders. It was hard for me at the beginning as well. I think it probably still is. But when we all have this great vision of what we're going to do and the starting which product and then all the other products we're going to sell and how, the different products build on top of each other. But in reality, if you start doing all of that from the very beginning, you run the risk of executing a few things at 70% instead of one thing at 100%. So that's really dangerous for us as founders at the beginning. So what we see is that the best companies just focus on one thing. They crush the thing, they really figure it out, and then they add complexity in layers, right? So you crush one product, and then you go and figure out act 2 and crush it, and then another layer of complexity, maybe a new geography, and so on. So focus. The second thing is that in order to optimize growth, we need to understand what the formula for growth is, right? And the way we think about it, and after talking with thousands of companies, is you can pretty much reduce it to 3 things. So one is the number of companies you're touching at any given time, times the conversion of those companies into a deal, times the value of a deal, right? So what the best companies do is that they really define that model, right? So they have an ideal customer profile. They know who is going to buy the product. They know how many of those customers there are. They map them all and put them in a database. They enrich that data with contacts, with context and so on. And then they set up a strategy to target and to interact with those companies on a recurring basis, right? So that's the first part of the equation, the number of companies that you contact at any given time. And then conversion. To increase conversion, they really define the use cases for each of the ideal customer profiles, so they can go very, very targeted with what this means for them. And then they set up referral programs because, a warm lead converts much better than a cold lead. And then last of all, for the value of each deal, they usually don't give discounts and constantly increase prices with the addition of new features and new integrations. And then the last thing is that in terms of how they run their businesses, they usually structure their teams kind of in a couple of levels. So the leaders really define and align on the objectives to achieve, the next stage of the company. And then they actually involve the team members in the definition of the key results. And then, once the team members have committed to something, they're more likely to achieve it. And then they actually enforce accountability really strongly on the team. That's great because it empowers the team and motivates them to excel. The next metric that we're going to look at is gross margin, which is probably the second most important variable or metric for a SaaS company. And why this is so important is because on the one hand, it defines scalability, and on the other hand, it really protects against downside. So to explain a little bit more, gross margin being really high, and the best companies have more than 80% gross margin consistently throughout the life cycle. This means that if your revenue, so gross margin, is that if your revenues increase 100 times, let's say if the gross margin is 80%, your costs only increase 20 times, right? This means that the company is scalable, and you need less resources to serve a larger base of customers than if your gross margin were smaller. And the second thing, very, very important in a downturn, is that if you have a high gross margin, it doesn't take you that much to sustain an existing customer base, right? So if you're into trouble and you need to go from burning money to actually making money, you can just stop investing in growth. And then having such a high gross margin or a high revenue base and a low cost base means that you can start making money immediately and have a positive cash flow immediately. So how do we get to that 80% gross margin as SaaS company? So the first thing that the best companies never do is they don't give discounts, right? Discounts really, really eat into your gross margin, because let's say that your price point is $100 and your costs are $20, right? So your gross margin is $80. If you sell one customer, you're gonna make $80 per year. Then if you give a discount of, let's say, 20% over the full price, then you're only going to get as revenue $80, but your cost base is the same. So you're only making $60 of profit, and your gross margin has gone from 80% to 75%. So discounts are really tough because of this impact, and then because it gets really hard to then increase the price for customers when you have started out with a discount. So best companies don't give discounts. The next thing is that the best companies usually don't attach any services revenue to licenses, right? It's because they want to be very scalable. And if you're adding services, that's not that scalable. However, when they add services, they charge a lot for it. If you're adding things that have a lot of value for like enterprise customers, like a 99.999% SLA, then charge a lot for it, because you're going to be adding services to maintain that. Charge a lot for it, right? And what we also see, like this is normal. When companies start, when SaaS companies start, usually they do more services revenue. They start productizing parts of that, so the gross margin goes up. And then as they get to enterprise level, they start introducing services again to implement and to integrate the SaaS licenses into the enterprise customers. So when you do that, charge a lot for it. And then the last thing is that upselling and net retention, which is something that we're all very interested about as well, is usually driven by adding features and integrations that are very, very close to 100% gross margin. Right? So you can just have more seats, or more integrations, or this little dashboard or whatever, and that increases the price tag, but it doesn't really increase the cost base. Then rule of 80 is the new rule of 40. And let's explain very rapidly what rule of 40 is, which has been traditionally the way that VC investors have looked at the efficiency of the growth of a SaaS company. So how we get to a rule of 40 is that you add the ARR growth year over year in percentage to the net income in percentage as well. So if that adds more than 40%, then it's good. That's kind of like the consensus. So for example, a company growing at 100% year over year in terms of ARR, and then burning, let's say, 60% of the revenue, would have a rule of 40. If they're growing 20% year over year, then they should be making 20% of the revenue in net income, and that's how you get to a rule of 40. And what we see is that the best companies actually have over a rule of 80. Right? The very best companies have, over 100, 120 rule of 40. So how do they do this? The first thing is that they just don't spend money on frivolous things. They're really, really, really careful about what they spend the money on. And basically, if it doesn't make the boat go faster, it's dragging the boat. This is true for everything, but in terms of money, if you're not spending the money on things that translate to growth, then you're probably not spending the money in the right way. So then, when you're ready to spend big, they don't spend big, and the areas where they spend the most are usually sales, marketing, user acquisition. They don't spend big until they have the operating model figured out, until they know exactly what's going to be the consequence of that spend. So the nice thing is that they don't grow expenses ahead of growth. They actually grow expenses after growth, And what this means is that, well, first of all, it's very tempting for us as founders to, when we have a problem, just come and hire somebody to fix the problem. But that's usually never the best solution, because you're throwing people at problems and then you're not incentivizing people to figure things out in a very efficient, high leverage way. So if you actually stretch your team members, because they're exposed to so much growth before hiring, that means that you're being much more diligent with your cost with respect to your growth, R40 again. And also, people, if they have limited time to achieve the same results, are going to focus on the highest leverage activities, right? So hire after the fact, once your team has gone through a little bit of a stretch. And then last of all is that the best companies that grow the fastest in the most efficient way have a very, very clear grasp of their operating model. That means that they know if they invest X amount of money today, how much money are they going to get, and when, and for how long is that money going to last, right? So if I invest $100 today, how much revenue am I going to get out of those $100? And then what's my retention, and how many payments am I going to get in the future? Because then what they know is that if they invest X amount of dollars, they're going to get Y returns. And then it's easier, it's less challenging to balance investment with growth. In terms of cash runway, which is another metric that we all care a lot about, what we're seeing is that the best companies have, keep traditionally more than 12 months of runway at any given time. And that's much more than the median. The median is actually at around 6 to 7 months of runway at any given time on average. So how do the best companies keep so much runway? Basically, what they do is that they only raise when they can, when they don't need to, which means that they have much more leverage to negotiate. And then they don't run into stress, or last minute things, which can be very distracting and can actually make you negotiate from a position of weakness. So never fundraise when you need it. Try to fundraise way in advance. And how to do that is by forecasting constantly and really well what's going to happen in the future. So the worst thing that can happen to us as founders is that you run out of cash because you're growing so fast, or much faster than you expected. Because then what happens is that you grind to a halt, and then it is really hard to build the momentum again, right? So what the best companies do is they're forecasting constantly what is going to happen if I add new customers, if I grow 2 times as fast, 5 times as fast. What happens if I enter a new product, if I enter a new market? What happens if those bets don't pan out? And then take into account the impact in cash that's going to have, then they go and fundraise way ahead of time. One thing that anybody here can do in this call is really focus on recovering the CAC early. So then let's go through an example. If you sign up a customer and signing a customer costs you, let's say $10,000 of customer acquisition cost, and then the customer pays $1,000 per month, it's going to take you 10 months to make money on that customer, right? So you're going to spend $10,000 and then you're going to get $1,000 back and back and back for 10 months, and then you start making money. So if you sign up 3 customers, you're going to be like $30,000 down. If you sign up 100 customers, you're going to be down, $1 million, right? So this is terrible, because the faster you grow, the less money you have, and the less runway you have, and the more stress you have, right? So the best companies actually recover the CAC really early. Basically, you have 2 levers for that. One, you charge everything up front, and that's tricky because then your customers may not want to pay up front and they may leave or like go and buy a competitor. Or 2, you just use financing to get all that CAC very quickly. So your CAC payback goes to 0. And then the more customers you have, the more money you have. So the last thing is that the best companies, in terms of managing runway, they actually differentiate the uses of funds with the sources of funds. So every company has two types of activities, long-term activities and short-term activities. Long-term activities with uncertain returns would be investing in R&D, launching new products, entering new markets, new geographies, right? So if those things pan out, it's amazing. You're gonna make an amazing return. If they don't pan out, well, you just spend money, like you've wasted money. It's part of being a founder, right? Like you take asymmetric bets. And then you have short-term activities that are usually much more predictable. Things like user acquisition, that operating model that we talked about earlier. If you invest $10,000 in a user, you're gonna get paid back over 10 months, you're gonna be making money, and then you're gonna make money for the next 3 years, for example, right? So the best companies use sources of funds, that are aligned with the activities in terms of terms and returns, or terms and costs. So for example, equity money, VC money is very long-term because you don't need to return it in the form of payments to your investors, right? So then they use VC money for those long-term activities that if they work out, they give amazing returns. And if they don't work out, at least with VC money, you don't need to return the money. And then they use debt or non-dilutive capital for short-term activities that are predictable, right? So things like user acquisition, they can scale to infinity. The more you grow, the more money you're going to need to keep growing at the same rate with a larger customer base. So instead of sinking your equity money into it, which you can run out of cash very rapidly, they use debt that is lower cost, predictable, shorter term, and gets paid back with customer payments. Another key thing that we unearthed during this report is that the best companies have more diversity than the median or the bottom quartile. So this is obvious. The more points of view you have, the more diversity of that you have, the better the outcome is going to be. So we've gone through what differentiates the best companies from the rest, and now we're going to look at how these companies are performing in the downturn. So what we did is we looked at all the data from the top companies before the downturn and then after the downturn to understand how companies are reacting. So in terms of growth, growth has slowed primarily as a factor of companies being more cautious with the funds they have because raising money is more uncertain. So then, companies are growing slower across the board. R80 is still important. It still is R80, and the best companies are still growing very efficiently. And efficiency is really, really important now. It's the first year that efficiency is more important than growth for investors. Then in terms of runway, we see that the median companies haven't changed that much, but the best performing companies have actually decreased their runway. They've gone from having a ton of runway to having a lot of runway as well, but considerably less. And the reason why is because they're actually spending more on capturing market share. So the old adage of be fearful when others are greedy. Well, now is the time when people are being very greedy, when the best companies are being very greedy, because everybody else is fearful, right? So they're investing in capturing market share from competitors. In terms of expenses, salary expenses have gone up across the board, and the reason why is because wages are more expensive because of inflation, and then CACs are usually more expensive as well as a consequence of wages, and also as a consequence of ads being more expensive since the last few changes in iOS and so on. I mean, as a consequence of slowdown in growth and and increasing expenses, we're seeing that net margins have deteriorated. This is normal, and it's also across the board. So to wrap it all up, we've gone through what differentiates the best companies from the rest. What's happening in the downturn, and now we're just going to wrap it up with a few recommendations. So probably if you need to remember, something from this call are the 4 things that I'm going to share now. The first one is to forecast all the time. You really need to understand what's going to happen with your company during the next 12 months and do this all the time. Don't do it just once a year because everything changes all the time, right? Like your metrics change, your teams change, competitors change, the markets change, right? So you need to constantly forecast what's going to happen. And the best companies do this in 3 ways. They have a base case scenario, which is what you communicate to your team or you communicate to the board and what you live and die for. And then you have a low case and a high case. Low case is, look, if things don't work out, if everything fails, this is what we're going to do. And then the high case is, hey, if we start to see early signs of things changing, that's what we're going to aim for. And that's the opportunity I want to capture. Then, if you need to raise money, if you need to raise VC, you need to prepare vitally. Like, it's so important to prepare this year. Like due diligences are back, and you need to prepare on two things: on process and on expectations. In process, it is super important to have like all the data that VCs are going to ask you for, and then to run a very tight process, understanding what you want to get out of, right? So what every VC is going to ask for is an operating model, the past traction on revenue figures, a customer file, a pipeline, and a cap table, right? So you need to have, well, and a deck, of course. So you need to have all of that ready, so that when they ask for it, you just send it over, and like one more step is reduced. And then you need to share with them projections, and they'll have to be prepared as well, because they will stress test that and then ask you questions to which you need to have thoughtful answers. Ideally, you're lumping a bunch of these conversations together, because time is the enemy of every deal. So if you have a very drawn out process, people are going to know that you've been raising for 6, 9 months, 10, 12 months, and then that actually is going to spook them. So you want to run a tight process, talk to everybody at the same time. You're going to get more or less the same questions, so you can really learn very rapidly about those thoughtful answers. And then, if you don't manage to raise right now, cut the process, stop it, focus on the question that people have, and then start it again a bit later. And then aligning in terms of expectations, you need to prepare with that as well. Understand what VCs are looking for, and then understand what their definition of success is. And this is the more important, the more ownership you give up in a round, right? So if somebody's going to own a big portion of the company, you need to make sure that you're super aligned with their expectations and that you're prepared to meet those expectations. Then second to last is unit economics are extremely important. We've been talking about unit economics in one way or another over the whole chat, but this is extremely important this year. You need to understand your gross margin, what's your payback, what are your costs, how can those costs evolve? Because investors are really going to look into this, because again, profitability is super important, even more than in growth this year. Profitability in terms of gross profit. And then last of all, and probably this is top of mind for everybody right now, is that the best companies don't choose runway or growth. They choose both. And why am I introducing this right now? So, this year we've seen a massive compression in multiples. So companies were raising last year at insane multiples that have divided by 20 this year, or by 10 this year, right? So then founders have to make a choice, and it's a really hard choice. They're like, okay, so if my multiples last year were, let's say, double of this year, I need to grow twice as fast as before in order to just beat the hurdle and raise the next round at a higher valuation, right? So then they have two choices. They have either that, like they grow much faster trying to make up in growth what they lost in multiples, or the other option is actually extend runway through whatever means and grow slower, so that when they need to raise money again at a later date in time, that multiples have recovered, right? So it is really, really tricky. As a founder, what do you really do? Well, what we're seeing is that the best companies don't choose. They actually go and do both. They go for growth and they go for runway. And how they do it is by aligning, as I mentioned before, different sources of funds with different uses of funds. So VC money for longer term activities, and non-dilutive capital for short-term activities. And this means that the runway, instead of being money in the bank divided by all expenses, it becomes money in the bank divided by R&D expenses, right? Because they're funding sales and marketing with non-dilutive capital that scales as the company's growth scales, which means that the runway becomes much longer and they have more funds to invest into growth. So this is the key insights that we have discovered through this report and through our customer base of over 3,000 companies. And if you want to get more detail, you can just download the full report here or reach out to us in any way. We're happy to help. And I'm going to hand it over to the audience for questions.
Well, thank you so much, Miguel. It was a wonderful session. We really loved all the insights, and you kind of solved the entire equation with the cash, since that is the thing that is being most talked about right now. We actually had a few questions. So when you mentioned about that the companies need to forecast as much as possible, what kind of forecast variables would you recommend for these startups to look out for? Yeah.
Well, the most important things that you need to forecast are, like top line and bottom line, right? So top line, revenue growth, and then bottom line is, how much cash are you spending every month, right? So, and like what's the runway as a consequence of, how much cash you're spending and how much cash you have. So in between, like, that's very easy to say, but to understand top line and bottom line, you actually need to understand all the little, unit economics in your model. So how many customers are you adding? How much does it cost you to add each customer? How much revenue does each customer bring? What's the retention? And how much over how many months are these customers going to continue to pay you? And then understand the trickle-down effect that's going to have on the model. What are your salaries? What are your benefits? What are all your costs? To understand how much cash you're burning. And then, what happens if your forecasts don't work out? So if you think that every customer is going to make you $150 a month, then what happens? What is the impact in your model if those customers are only paying you $100 a month? Or what happens if your retention goes from 90% year over year to 70%? What is the impact in cash that it has? And then what that means is that as you operate, you're going to start filling in those hypotheses with your real performance. And then you can actually make decisions on like, oh, wait, I thought I had 20 months of runway. In reality, if things continue to go this way, I only have 8 months of runway. I need to fundraise right now, and I need to fix these variables, right? And if I move this variable from X to 2X, then the impact in my runway is Y, right? So have that model so that you can try to predict what's going to happen and then fill in those predictions with real data as you go along.
Absolutely. That's a wonderful insight. And I think it's inclusive of all internal and external factors that you need to take into account and kind of prepare for what's coming up ahead. Well, thank you so much for that. And since you were also mentioning about, cash run and gross margins as well, what is the biggest mistakes that you see these days that SaaS startups typically are making in terms of their finances at a very early stage when they start out? And how they should go about kind of prioritizing it. Yeah.
Right. I think that one big mistake that we see actually in terms of gross margin is companies thinking they have a higher gross margin than they actually do. And that's because they're categorizing things in the wrong way, right? So why is this important? First of all, investors are gonna see through it, right? So if you say they have a 95% gross margin because you're and then to get your product live, you actually need people like working on the product to make it live. Sorry, let me rephrase that. To sign up a customer and to service a customer, you actually need people working with the customer, and those engineering salaries, you're not including them as part of the gross costs. Then you're fooling yourself and you're fooling the investors as well. And they're not going to be fooled. So they're going to think that it's intentional, right? So intentional. So then they're gonna be spooked. So that is the biggest mistake probably. And I think it's not on purpose. I think it's just like a consequence of, just like being less experienced or whatever. But it is a big thing to avoid. And then that actually can have a high impact on runway, because if you think that, okay, wait, I'm just gonna slow down growth, I'm going to get cash, from all those customer contracts. But then you see that you still need to invest a ton of money to service those customers. And then if you thought you were going to get $80 out of every $100 of revenue, if in reality you need to support that revenue with a bunch of people, you're only going to get $20 out of every $100 of revenue. And that's going to impact your runway dramatically.
Yep. Absolutely. That's so very helpful. And since you mentioned that, it's a lot of first-time founders, they don't really have experience. So it means a lot for you to share your experience on this. And yeah, well, that would be it from our end. Thank you so much again for showering those insights. And I mean, I was constantly taking notes as much as I could, and we really found it useful. Thank you so much.
Of course.
Thanks for having me.